How a pension changes your retirement tax strategy. A quick note before we continue. Ads may play during this video. Your support keeps this content free. Now let's jump in. Imagine walking into a room where every dollar you earn is being watched by two different collectors, and both of them want a bigger piece of the pie simply because you have a pension. For most retirees, a pension is the ultimate dream of financial security, a guaranteed paycheck for life. But what no one tells you is that in the eyes of the IRS, your pension is a massive magnet for higher taxes that can actually destabilize your entire retirement portfolio. If you have a pension, your strategy for Social Security, your 401k withdrawals, and your capital allocation must be completely different from someone without one. If you do not adjust, you could find yourself in a situation where a simple cost of living adjustment actually lowers your spendable income. The reason this matters so much right now is the massive shift we are seeing in 2026 tax legislation under the One Big Beautiful Bill Act. We are currently facing a significant tax transition as the core provisions from the 2017 Tax Cuts and Jobs Act are moving toward their permanent integration or expiration. For anyone with a pension, this creates a compounding problem. While the 2026 standard deduction has increased to $32,200 for married couples, and the new Senior Bonus Deduction adds another $6,000 of protection for those over 65. These buffers are often swallowed whole by the way pension income is treated. Unlike long-term capital gains, which can enjoy a 0% tax rate at certain income levels, your pension is almost always taxed as ordinary income. It sits at the very bottom of your tax bracket, pushing every other dollar of income, including your Social Security and your IRA distributions, into much higher, more aggressive tax tiers. To understand the gravity of this, we have to look at the invisible math of provisional income. The IRS uses a specific formula to determine if your Social Security benefits are taxable. They take your adjusted gross income, add any tax-exempt interest, and then add exactly 50% of your Social Security benefits. Here is where the pension trap snaps shut. Because your pension is fully taxable and counts 100% toward your adjusted gross income, it fast-tracks you toward the $44,000 threshold for married couples. Once you cross that line, up to 85% of your Social Security benefits become taxable. For a retiree with a $50,000 pension and $30,000 in Social Security, you are not just paying tax on the pension, you are effectively paying a double tax because that pension is the very thing making your Social Security taxable in the first place. This creates a marginal tax rate that can feel more like a penalty than a tax. The most dangerous part of this equation is what I call tax-induced benefit erosion. In 2026, Social Security recipients are seeing a 2.8% cost of living adjustment. On paper, that looks like a raise. But for a pension holder, that extra income might be the very thing that pushes your provisional income over the limit, triggering a tax on 85% of your benefits. When you factor in the 9.7% increase in Medicare Part B premiums, which are now over $200 a month, your actual take-home pay could actually decrease despite the raise. This is why institutional wealth management focuses so heavily on income characterization, rather than just the total amount of money coming in. So, how do we navigate this as sophisticated investors and business owners? The first principle is mastering the art of liquidity management through asset-based lending and strategic capital allocation. If you have a pension, you already have a high floor of taxable income. This means your traditional 401k or IRA is a ticking tax bomb. When you reach the age for required minimum distributions, or RMDs, those mandatory withdrawals will be layered on top of your pension. In 2026, these interactions take on added importance. If your pension already puts you in a solid tax bracket, a large RMD could easily push you into the 32% or 35% range. This is why the second principle is aggressive multi-year Roth conversions. By moving money from a traditional IRA to a Roth IRA now, you are paying the tax at today's rates to ensure that your future distributions do not count toward that provisional income formula. Remember, Roth withdrawals do not trigger Social Security taxation. The third principle involves a strategy used in private banking called the securities-based line of credit, or SBLOC. Imagine you are a retiree with a pension who needs $100,000 for a luxury purchase or to bridge the gap between selling a home and buying a new one. If you take that $100,000 from your IRA, you might pay $30,000 or more in federal and state taxes. But with an SBLOC, you borrow against your non-retirement brokerage account. This provides tax-free liquidity. You get the cash, your assets stay invested and continue to compound, and crucially, your adjusted gross income stays low. This prevents your pension from triggering those higher tax tiers on your Social Security. This is the difference between average retirement planning and true wealth preservation. Furthermore, we have to look at the 2026 updates to the SALT cap. One of the major highlights of the new legislation is that the state and local tax deduction cap has been increased to $40,400 for taxpayers with income below certain thresholds. For those with significant pensions in high-tax states, this is a game changer. It allows you to shield significantly more of your pension income from federal taxes by itemizing your deductions. Previously, you were trapped at $10,000, but now your real estate taxes and state income taxes can work for you. For business owners, the permanent extension of the 199A qualified business income deduction provides a massive 20% reduction in taxable income from pass-through entities. This is a level of tax optimization that goes far beyond what the general public understands. Many people wonder if they should just take their pension as a lump sum to avoid these annual tax traps. That is a complex decision involving your internal rate of return and your life expectancy. If you take the lump sum and roll it into an IRA, you have deferred the tax, but you have also grown the size of your future RMDs. For those who choose the monthly annuity, you are essentially locked into a specific tax floor. This is why high-bid financial strategies often suggest using that pension income to fund the taxes on a Roth conversion. You use the guaranteed cash flow to pay the IRS today, effectively turning your other assets into tax-free buckets for the rest of your life. It is about shifting from defensive saving to offensive wealth positioning. Another major hurdle for pension holders in 2026 is the IRMAA surtax on Medicare. Because your pension is part of your modified adjusted gross income, it can easily push you into the next IRMAA tier. For a married couple, if your income exceeds $218,000, your Medicare premiums don't just go up, they skyrocket. For some, being just $1 over the limit can cost an extra $4,000 a year in premiums. This is where strategic charitable giving, like the qualified charitable distribution, becomes essential. If you are 70 and a half or older, you can send up to $111,000 directly from your IRA to a charity. This satisfies your RMD requirement, but does not show up as income on your tax return. It is the most effective way to lower your income and keep yourself out of those higher Medicare brackets. For our international viewers in the UK, Canada, or Australia, these concepts of income characterization are universal. Whether it is the lifetime allowance changes in the UK or the superannuation transfer balance caps in Australia, the goal is always the same: ensuring that your guaranteed income does not destroy the tax efficiency of your flexible assets. While the specific names of the accounts change, the principle of capital allocation remains the core of a high-level wealth strategy. Now, let's talk about the specific action steps you should take immediately. First, you need to perform an itemization stress test for 2026. With the SALT cap at $40,400, you need to see if your property taxes and state income taxes now outweigh the standard deduction. Second, if you are over the age of 70 and a half, look into qualified charitable distributions or QCDs. Third, evaluate your 2024 tax return, because that is what will determine your Medicare premiums for 2026. If you had a one-time spike in income, you may need to file an appeal based on a life-changing event like retirement. Fourth, speak to a specialist about an SBLOC or an asset-based loan if you have major capital needs. Do not let a single large withdrawal trigger a cascade of taxes across your entire portfolio. In summary, a pension is a double-edged sword. It provides incredible security, but it also acts as a floor that makes every other financial decision more expensive. You must move away from a savings mindset and toward a distribution mindset, focused on tax-efficient capital allocation and liquidity management. By utilizing Roth conversions, strategic charitable giving, and being mindful of the 2026 SALT and Senior Bonus Deductions, you can keep more of what you have spent a lifetime building. You have worked hard for your pension. Now make sure your tax strategy is working just as hard for you. If you found this deep dive into retirement tax strategy helpful, please hit the thumbs up button to give us a like as a thank you for this valuable content. We are uploading fresh videos on these high-level financial subjects regularly, so make sure to subscribe so as not to miss the next strategy that could save you thousands in unnecessary taxes. I would love to hear from you in the comments. Has your pension ever pushed you into a higher tax bracket than you expected? Or are you currently planning a Roth conversion to avoid the RMD trap? Share your thoughts or ask a question below. Please remember, I am not your financial advisor. The strategies discussed in this video are for educational purposes only and involve complex tax laws that change frequently. Always seek professional advice from a fiduciary financial advisor or a qualified tax professional before making significant changes to your financial plan.